What you're telling me is that music is about to stop, and we're going to be left holding the biggest bag of odorous excrement ever assembled in the history of capitalism. 1974, 1987, 92, 97, 2000, and whatever we want to call this. It's all just the same thing over and over. We can't help ourselves.
I say when we sell. Hey, I say when we sell.
Gentlemen, the signals are going off. BlackRock is here. Matt Dines is joining us for episode 5 of The Last Trade. Matt, welcome. Let's start it off with the signals we're saying. I was saying right before we hit record, I've got an investment banker in the family, a cousin-in-law, if you will. When things are happening in that side of the industry, of the finance side of the world, I usually get a text from him. I got a text from him yesterday. I think BlackRock has sent a signal out there, and you have all of Wall Street trying to figure out, all right, what is our Bitcoin strategy? What are we doing? I won't get into the specifics of what he reached out about, but Wall Street seems to be interested in what Bitcoin companies are doing these days.
I had a signal too. A Stanford friend of mine who has been bullish on crypto broadly reached out yesterday a little bit in despair about the future of crypto because it suddenly seems a lot darker with the SEC coming in and making its actions. And, you know, I think that's part of the journey towards Bitcoin is realizing that everything else doesn't have staying power. And it feels like that is a little indicator for me that my network is just a little bit closer to seeing that Bitcoin and crypto are different, and Bitcoin has real value and real legs, and it should be a part of everybody's portfolio.
Yeah, I think it's very, very interesting times. We have a directional idea what's going to happen over the course of this year, next year, and as we've started kind of the sales motion with on-ramp and outreach and inbound, credit to Jesse and his piece this week with BlackRock Trust and on-ramp, and one's a bicycle and can run properly, and one stuck in mud or is inevitably going to be stuck in mud. We had some conversations with unions that have allocated in small amounts, but what was interesting is that they said now other unions are looking at them, asking them what the playbook is, how they could evaluate. And today I had a really good conversation with a pension fund in early stages that are asking all the right questions on the fundamentals. They realize it's been the best performing asset for 10 years, but also at the same time, they haven't figured out how do they hold it long term. And so we think we're onto something and being able to help them. But it's just early days, right? So it's going to be very interesting next, let's call it 18 to 24 months.
Yeah. Matt, you getting any signals out there?
So, well, if you just look at the week in review, there wasn't that much news from what you call like just the broader capital markets, the broader finance. It was really, the lines hitting the ticker that I review. The big ones were obviously the SEC enforcement, the things going on with what would you say, like the Prime Trust situation, the Binance situation, the True USD situation, everything there. Seems like the action is happening. And then on top of that, you had just the cover smoke signal of the BlackRock Bitcoin ETF. But on top of that, you saw other just kind of infrastructure news that the capital markets players are showing up. Two big headlines, I think that I saw that showed up on my radar. So there's the firm EDX Markets have been kind of building up, but these are the big boys showing up. So backed by I want to say Fidelity, Schwab, and Citadel. Their CEO is the former global head of business development. It's a spot trading firm for, I'm going to say Bitcoin, but they're not exclusively listing Bitcoin as their sole focus. They list, the other, I'd say just crypto assets, if you will. I don't like these terms, but the other stuff, they do include that on what they're offering on their trading desks. But from that angle, to show up with that degree of a caliber of a person launching this project, like it's telling you, like they're mobilizing the troops, for the invasion into Carthage. I think it's coming. Another one I saw, Elwood Technologies. This firm is backed by Alan Howard, like billionaire co-founder of a massive hedge fund, Brevin Howard. They're basically creating, portfolio management and order management system for institutional clients. So our firm Build we use for our order management system. I can explain what that tool does a little bit, but basically Bloomberg announced a partnership, and this has been a few months in the making. And all of this is public info too, so I'm not sharing anything that's not on the newswire if you're looking for it. But they announced portfolio trading for Bitcoin, but they also list those others. Obviously, they're not showing up with an exclusive Bitcoin focus, but that's where we believe the action is. But yeah, the order management system for institutional players it's part of like the table stakes that you need for tools and infrastructure for this to show up and be like a reliable asset class for capital markets and scale players, if you will. So when I say that, that acronym order management system, or OMS, it just means like when you're trading for a client account, like let's say Build, we manage multiple clients' funds. When you need to buy or sell, a holding in their portfolio, you need to show like a ticket, if you will, like an order ticket. Same way if you go, order food at Cooper's Barbecue or something like that, you'll get your ticket back. Shout out to my Austin friends. Want to make sure I put this in, the terms you guys like to see. But you get a ticketing and like a timestamp, a price that your trade was struck, volume, and then your counterparty for that. So you see this system, build out going on, and then also like the spot market development where you don't have, just like the bucket shops, the Binance, all of these exchanges that are just, fly by night. They come, they go. It seems like you're seeing right now the infrastructure getting built at the base layer for the scale players to show up. And over the long time frame, it's not just going to be a quick copy paste of the old system onto the new. I think this will change everything.
Yeah.
Yep.
Feels like it's happening.
Yeah, it does feel like it feels like Wall Street wants to run this industry, the crypto industry in particular. I found it interesting that like EDX, the Schwab, Citadel, and who else was it? Is it Fidelity? Also part of that.
Yeah.
They're not just going to do Bitcoin, which means that they believe that the SEC is not going to like completely clamp down on crypto, or at least for the foreseeable future, which then kind of casts into doubt, like why is the SEC going after crypto and crypto companies like Binance, but they're going to allow EDX to set up shop and do the same sort of thing in a more professional, more Wall Street way. It does seem like regulators are kind of clearing the slate in order to make room for the big boys who have decided they can't miss out anymore.
So I would say it'd be good to have a lawyer on to bring the perspective on this, because there's just demarcation lines that can be drawn. So obviously Bitcoin with the Immaculate Conception, its UTXO set, that's treated as not a security, or it's on one end of the spectrum, like put it as further to the left on as decentralized as you can be, as clear as you can be. This is a commodity ledger money. And then you go to the right, the full end of the spectrum, it'd be like the A16Z coins, just spinning up projects, get the wash trading going, and pump and dump type of securities. And there's some demarcation, along the middle. And if you're using something like, you guys know this space better than I do, but something that forked over the UTXO set from Bitcoin at one point, or if it was just like a hard fork of the technology, those are the things that are kind of grandfathered in or treated as differently than these just startup Silicon Valley funded tokenization, pump and dump type of thing. So it's somewhere in there, and you're not going to see any of these at this point in time just coming in as Bitcoin only, is kind of what I'm reading as I go through these news announcements.
Yeah, the institutions have to learn their lessons too. They're going to get wrecked They're going to get
Oh, yeah.
robbed.
Oh yeah.
But
Yeah. And BlackRock might be a big part of that for some of these people because of the paper Bitcoin claims that will be created out of their product.
well, I think it's a good opportunity to jump into this. Obviously, news of the week is BlackRock. They're filing for the ETF, the trust. We'll just call it an ETF. Just run with that, even though it's probably not. Jesse, we'll let you elaborate on that. But I think it's great that we have Matt on today during this news week to set the stage for this conversation. Matt, we booked you a few weeks ago before any of this was news, and it's a bit prescient that you're with us this week, particularly because, all right, BlackRock filed for the trust, which essentially will operate like GLD, which people refer to as an ETF. Jesse, you dove into the filing and wrote a piece and a nice thread on exactly what the trust structure is, what individual clients or people buying into that trust are going to be able to do in terms of taking the Bitcoin in kind eventually, or not being able to, as it seems, the paper Bitcoin that can leak into that structure. And I think having Matt here to build on that conversation, BlackRock, obviously the largest asset manager in the world. A lot of people have tied up their retirement funds with the BlackRocks and Vanguards of the world. And that is something that Matt is very passionate about, the situation of retirement accounts in the U.S. And so let's start with jumping into the structure of BlackRock's trust, how it works, and then I think we can dive into the landscape of retirement accounts in the U.S., how BlackRock plays into that, and how Bitcoin, we believe, can really help retirees as their retirement accounts begin to fall underwater.
Awesome. Yeah, I'm looking forward to this one. So I spent last weekend kind of digging into the BlackRock product and pouring through their S1 filing, what they intend to do with this product. It's a trust. It's a grantor trust model, which is a great model and is in fact what OnRamp's Bitcoin trust is structured as. That is an excellent model for Bitcoin, specifically because as a single commodity investment vehicle, a grantor trust allows the tax status to live with the investor. So it's, for tax purposes, owning a share of BlackRock Bitcoin Trust, since it's a grantor trust, is equivalent to owning that underlying Bitcoin from a tax perspective, which means that when that investor wants to withdraw in kind that Bitcoin, it isn't a taxable event. And that's essential for delivering that desirable attribute of this trust structure, no taxable events on in-kind redemption, which is great. And that's how it should be. That's better than GBTC. GBTC is not structured that way because to get out of GBTC, you can't withdraw in kind. You have to sell your shares into dollars and then use those dollars to go buy Bitcoin. So that's a taxable event. And so, in that transaction, you could take a 30% hit on the value of your holdings because you have to go pay the tax man. So the grantor trust side of what BlackRock is doing is great. It's a good design. And the other benefit of what is happening here is that because this is a spot product, not a futures-based product, it means that BlackRock has to actually buy Bitcoin. So any allocation that they make towards Bitcoin via this fund from the $10 trillion of AUM that they have, that means buying Bitcoin. So if they had a 1% allocation of their 10 trillion under management, that's $100 billion worth of demand that would be spread out over some time. But that seems reasonable over the next few years. And $100 billion of inflowing demand, for an asset that's $500 billion in total valuation, but most of it is not available for sale, means that your $100 billion of demand is bidding for a tiny pool of what is available for sale, which will, and since price is set at the margin, and you're going to string out a series of trades that amount to $100 billion of inflowing demand, bidding up the price of Bitcoin dramatically in order to find supply willing to be sold. Massively bullish for Bitcoin in that sense. So that's the good of what BlackRock is doing. The bad of it is that it's BlackRock, and they're bringing BlackRock norms of governance and custody to an asset that doesn't play nicely with that type of expectation. So the three, in my mind, biggest problems with this is, first of all, rehypothecation. There's nothing that prohibits BlackRock from lending out the Bitcoin that ends up in their trust. As a result, they will do that. So they will get a little extra yield by lending the Bitcoin that they're holding to the Three Arrows Capitals types, maybe the BlockFi types, who are going to go further out on the risk curve and do something with that Bitcoin, and maybe it works out or maybe it doesn't. So they're going to generate a little extra yield that way. But in doing so, they're creating paper Bitcoin claims because they're taking the Bitcoin in the fund that the investors in the fund think they own, and they're giving that Bitcoin, they're lending it out to somebody else. And then now there's two claims on that Bitcoin. There's that Bitcoin lives with somebody who's borrowing it, but the original investor in the trust thinks that they own it. And actually they have a paper claim on it now. So in that way, you're going to be creating paper Bitcoin, messing with the supply of Bitcoin in the process. And ultimately that loan either has to be resolved, get closed, and in order to restore that there's one Bitcoin for one claim, or if it goes sideways, somebody's stuck without Bitcoin because there's two claims and only one coin. So that's a big problem with the rehypothecation side of things. That's such a deep rabbit hole that I get lost. Yeah, go on.
Well, is it explicit that they're able to rehypothecate? Is it something that's just not mentioned that they can't, and therefore it's implicit maybe that they could and probably will?
It's implicit, and it's the norm with ETFs in general, that this is just how Wall Street does things. Like, you're allowed to lend out the assets in an ETF, and so people do, and there's nothing in the S1 that says they can't do it, which means that they're going to do it.
Yeah. And Michael,
Matt, go ahead. Sorry, Michael, if you have something, go ahead. I had another angle too.
Yeah.
It's a problem. Creation redemption.
Yeah, I think there's a couple of components to this that would be interesting. One is I'm really excited to have Matt join because I feel like he's our resident Bitcoiner inside. We saw you look to your right or left, whatever direction, where I'm sure you have a Bloomberg screen and you're talking the lingo and you know what's happening in that world. And one of the things that came up when we started thinking about on-ramp was finding out from folks between BlackRock and Citadel that BlackRock had institutional demand, but they did not want to face quote unquote Web 2, Web 3 companies, and Coinbase fell into that. This is even before FTX blew up. And so part of that was the EDX formation, which came from, again, Fidelity, Citadel, and Charles Schwab. And so that all sounds good until you realize the back end engine of that was Paxos. And I think they were even going to leverage them for custody. I guess that's kind of changed now. These are marketing themselves as a decentralized exchange, and they're going to have the settlement somewhere else. And maybe it is Paxos still. But regardless if it's Paxos or not, the reality is all these custodians are the same thing. It's just, there's no difference between Coinbase, FTX custody, or Paxos. And the reality is that looking at this and seeing what happened the past few years had this realization that we're just going to see this orders of magnitude larger, whether it's the rehypothecation from BlackRock or someone else, or the centralization of the assets, and just the similar just destruction of capital that happened. And so one of the things that I'm just curious on your side, Matt, is what do you think's changed with that? Because we talked about the dance with the SEC, and now they're letting the firms come in, And like there feels like there's something with Coinbase like bending the knee that is happening in the background of like, okay, BlackRock, we're here, we're going to use Coinbase, they have the infrastructure, but like it's almost like we own you at this point, because at the other side we're talking about fees. The structure of the fees completely kneecap exchanges when it comes to the compression of fees within an ETF. And so there goes Coinbase, liquidity and trading fees when it comes to that, along with a bunch of other exchanges. So I'm curious, do you think anything's changed or what's happened over the course of the past 6 months where Coinbase is now looked at as a counterparty that institutional investors are going to be willing to trust with their Bitcoin?
So I think over the last, 15 months, right? Last spring, what was a point in time where you had a lot of filings going out, but they were getting pulled. And, this is pretty well known. I was looking to, find some solution on top, like build around Bitcoin. I think this is, how we got to this point where we are today with this private placement offering or private placement that we have. I've talked about with the Unchained Bitcoin backed loans. But we were looking at evaluating, how do you go through this process? What could we bring to market? And in that process, you talk to lawyers, and you see what everybody else is doing. And we were told, I think it was last March or April, it's like don't file here. We had another asset manager who just, submitted a filing, and they were told to pull it back. Like they were asked by the SEC to withdraw. It's not a rejection. It's just like, just don't do this right now. So it was kind of known, at least from what we were told by our lawyers who were plugged in with the capital markets. This is what they do. Big law firms. They said just pull back. This is just hot stove. Do not touch this right now. And then as of this week, right, it's like, oh, we're back. We're game on. So I don't know if it's tied to certain shoes dropping over the last 15 months where we've seen certain players like the leverage buildup in the system. People doing things building on top of unsound practices, those going wrong, and getting exposed, or if it's just kind of learning where within the the X's and O's or the black text on the white paper. How do you map this offering, right? If we have this goal, like everybody's known about this prize that's sitting there for someone to go get, to have an exchange traded offering with actual UTXO, like spot Bitcoin, I guess is the term people use. Who is the first one who can take that hill? Like you're sitting on, a revenue stream of fees and commissions, and this is the way Wall Street has kind of viewed it and known about it for a while. But is it an element of like the right things had to happen? The right regulatory actions were taken, the right backroom, meetings were made. I don't know that. Or is it just they figured out how to submit the filing to increase their prospects of, hey, we think we can get this thing through the door and make this happen? I don't know. It could be a bit of both. We don't know as the outside observers, but it could be somewhere in between. But it went from, I would say, like the temperature went from do not touch this thing 15 months ago to now. You see what happened. One, BlackRock went, and then now you had a land rush. I don't know exactly the number who came out with follow-on filings, and I know Wisdom Tree.
I think it was
six. Yeah. So it's back on again. They're going for the land rush, and this isn't going to change. I don't know if we're still in a bear market. I would just assume we are until we hit another all-time high. But it's getting ready for the land grab. You can see they're positioning for the next bull market.
Yeah, it's really interesting again because I tweeted this out earlier today, and Jesse, I mean, you alluded to it with the rehypothecation, and OnRamp has obviously created the custody of the Bitcoin held in the OnRamp trust in a very specific way to leverage Bitcoin's native properties, particularly multi-sig, and that's what's going to be incredibly fascinating to watch play out over the next 3 to 5 years is Wall Street getting acquainted with the technology side of Bitcoin. Like, how do you custody this? Do you use a third party? Do you use multiple third parties? And it's going to be fun watching Wall Street learn these lessons because, as we know, Bitcoin has these native properties that make it very easy to build sound and secure financial products on chain, particularly with multi-sig, that Wall Street doesn't seem to grok yet. Obviously, with BlackRock, not Blockstream, using Coinbase as custody, that is a signal that they sort of don't get it yet, as they probably should. And that's like another aspect that's thrown into it. Like, we are so early, Bitcoin has these native properties that really don't map to the incumbent financial and banking system. And we're so far ahead of the curve on ramp, particularly Unchained. Companies that are leveraging multi-sig, River, Strike, are so far ahead of the chain, the trend in terms of native security of Bitcoin. And so let's just touch on that. Like, why on ramp? I know we explained it in the past, but I think juxtaposing it to the BlackRock filing and their offering, if it gets approved, is really important for people to understand and intuitively grasp, because the decision to allocate to one trust with a certain security model versus another is a pretty big one.
Yeah. So, well, I'll cover off a little bit more on the BlackRock side of. We touched on rehypothecation. There are two other problems that come up with how they're approaching custody and governance. And one is who's allowed to do in-kind redemptions. What's that redemption process like? The other is what happens in the event of forks. Together, those three problems are emblematic of how Wall Street has yet to appreciate that Bitcoin has these properties that protect client rights and by minimizing counterparty risk, or making it easier to audit and control and see, and limit the ability to rehypothecate this asset, because it can live on chain. It can live in a multi-sig vault where 3 different parties control that vault and 2 are necessary to effect control. And then that prohibits the ability to do any funny business, any rehypothecation, because you can't lend it unless you have the agreement of multiple institutions involved, which is how OnRamp is built, but it is not how BlackRock is doing things, because as their custodian model is they're handing it to Coinbase. So now you've got 2 counterparties stacked up here. You've got BlackRock and the risks there with them as a counterparty, and then you've got Coinbase as your custodian and the counterparty risk there, and that is not as good as diversifying your counterparty risk by splitting it into 3 different keys in a multi-sig quorum. So yeah, the in-kind redemptions problem with BlackRock's model is that you're only allowed to withdraw in kind your Bitcoin if you are an authorized participant, which means a registered broker-dealer firm that has entered a separate contract with BlackRock, and is in the good graces of BlackRock at that point in time. So that obviously is a list of firms with that right that can shift and can go to zero depending on what BlackRock wants to do, and that reduces the rights of the end client to access their Bitcoin versus what's possible. The other problem here is the forks situation, where there's a kind of a large section in BlackRock's filing that specifies that in the event of a Bitcoin fork, BlackRock asserts the right to determine which fork is the real one, and which one they will honor. And the one that's not real in their mind, they can ignore or sell off those assets, depending on what they want to do, which is problematic because this is BlackRock, and they're the originator of the ESG score concept. It's them. That's their thing. And it's ESG. The ESG score is effectively a capitalist social credit system. And
it's not really capitalist. It's pretty communistic.
Well, it's a social credit system wrapped in capitalism.
Marty's a big fan of ESG, so we're gonna.
You can see my shit-eating grin here as I.
Yeah. And so you play that forward, you can obviously see a scenario where BlackRock would, let's say BlackRock's trust ends up becoming a very large holder of Bitcoin. Then they get some pressure from the government to, impose a change on Bitcoin to fork it and create an ESG friendly Bitcoin, or call it green Bitcoin, whatever. And now you're looking at a Bitcoin Cash scenario where there's corporate interests pushing for a fork, but now it's not like small time players. This is BlackRock and the US government pushing this fork, and they're holding hostage a lot of the institutions that have gotten Bitcoin exposure through this trust. And that becomes a scarier fight than Bitcoin Cash was. And that's all because in this document, BlackRock asserts that right, and it's just in legalese and hard to really see the threat there, but it's there, and it doesn't need to be that way. And so, OnRamp's model is to use that grantor trust model, which is excellent, but to leverage Bitcoin's properties of custody and governance to deliver best-in-class custody through the multi-party custody solution that we have, where we have 3 institutions holding a key to our vaults, and 2 of those institutions are qualified custodians. And it should all be about the rights of the client to access and control their Bitcoin, and not about a permissioned system where you have to be in the good graces of BlackRock, who can change the rules at any time and can impose their politicized desires to petition for change with a fork in Bitcoin's code.
Yeah, and just to expand on that, I think Marty's tweet earlier was a little inspired from conversations we have, in the sense of there's 2 parts, and this is one of the funnest times to just be involved in all of this stuff, because we're basically, if somebody's been working in the space or looking at it, they've seen this stuff play out. We know how this ends. So Jesse, to game out what Jesse just alluded to, the closest, at least in my mind, parallel was BlockFi and the lending model that they had. And we experienced this at On-Chain Capital on the lending desk, where in nominal terms, it was more expensive to go and take a loan from On-Chain versus BlockFi. And what we experience is, having those conversations, and we'd explain that nominally it costs a little more to take a loan, but risk adjusted, it's a lot more expensive to take the BlockFi loan. Because we understood, and people, that it's just an asymmetry in information, what Jesse just alluded to. It's the market not fully understanding, one, that this is a different kind of asset. There are no bailouts in Bitcoin. You can't print more Bitcoin if the Bitcoin is lost, stolen, hacked, or you're rehypothecating and the tide goes out and you're caught short. But in the same situation in BlockFi, over the course of years, we would start to see more individuals realize, as that information was disseminated in the market, oh, this isn't the right way. I want to know my Bitcoin's on chain. I want to know, I'm willing to pay that additional, extra bips to know that the Bitcoin sits there. It's not being relent out. And it was really fascinating, because during the conversations over the course of years, we would say the difference, or I would personally say, and I felt it was a bold statement, but I believed it. I didn't know it would happen so quick. Is that the difference between BlockFi and Unchained's market cap was simply in the delta between information, similar as Bitcoin becoming money, is just understanding of all the things that individuals have spent the time looking at. And little do we know, 12 months later, whatever the time frame was, that BlockFi, basically enterprise value is 0 or negative. And I think of it sounds like blasphemy and it's crazy to even say it, but I feel very similar to any structure that goes against the principles that we're talking about here with Bitcoin and the centralization. This is an asset that doesn't have to be held in the old way. We don't have to map the old world to it. And part of Marty's tweet earlier was talking about, qualified custodian. I don't know it verbatim, but it was basically referring to there are legal confines and regulatory structures that we have to adhere to. We're U.S. citizens, and there's things to offer financial products. But at the same time, there's a way to offer those with also staying as close to Bitcoin's principles that allow for the longevity of the custody and just being able to hold that asset, right? It's very easy to buy Bitcoin. It's hard to hold it long term through the volatility, exchange hacks, and everything that we know. And so I think that's very important because there's plenty of people out there that will tout, oh, because it's in a trust structure, or because it's in a qualified custodian, or because it's BlackRock. But at the end of the day, like Bitcoin has shown over 13 years, that it doesn't matter who's holding it unless you do it in the right way. Your Bitcoin is at risk of being gone and being gone forever because you can't make more of it. And I think that's the fundamental thing that we see with BlackRock is people that have looked at Bitcoin long enough that there's no world where BlackRock holds a lot of Bitcoin, call it hundreds of thousands, not millions, that it ends up good for the people that are putting their dollars in and thinking they have Bitcoin.
Yeah. Yeah, my tweet earlier was like, you can check all the legal boxes, you meet qualified custodian, you can meet all the SEC's regulations, all the banking regulations, but if you don't grok Bitcoin security and build your product around Bitcoin's native properties, there's no legal checkbox in the world that can save you from losing people's Bitcoins. Security.
Yeah, and that key point, like, is the liabilities and asset mismatch. Like, the common thought that came up about BlockFi, even, and I was part of it, was like, well, if BlockFi has a hole or a zero, like Peter Thiel, they'll back them up, they'll fill it. And that common thought happens now with Fidelity or BlackRock that if something happens, if they're hacked, if there's a mismatch in the rehypothecation, lending, whatever might happen, they're such large institutions that they'll backfill. But if you think about it, the idea is if somebody's holding that asset, then they're looking at the price to go 10x, 100x, whatever the number is, and at some threshold, they're upside down in what they're holding versus the enterprise value. And at that point, that's where the question happens. One, if they're hacked, or something happens to the funds, it's more than likely a zero. But then also, and this ties in, I was having this conversation earlier, to being able to take redemptions. Because if that price appreciates, then there's this like stance in Bitcoin. You should always think about your MBK touts. I don't know exactly where it came from, but it's just the thought that, you always want to think about your security model as if the price of Bitcoin is 10x what it is today, because it inevitably will. And then you don't want to be scrambling when it does that. And similarly with having it with BlackRock, you can imagine an institution or endowment that allocates $1 billion, whatever the number is, and now it's 10 billion. And BlackRock's holding trillions, and you're thinking, wait, this doesn't make much sense, but you're stuck because you can't take it. And we've seen what happens with people stuck with GBTC. So like Jesse's piece was great because it really laid out the fundamental things that we thought about with OnRamp and the difference between what BlackRock got and the visual of the bike with one wheel while it's stuck with a square, whatever the square thing was, a rock maybe, was very apt in explaining how our vehicle moves.
Yeah. And Matt, did I catch it correctly earlier? Were you about to go into the potential duration mismatches that could arise if they do rehypothecate?
I was going to talk about the creation redemption. Just to echo on what Michael's saying, like the risk, right? You're on the back end of a fund, financial product, et cetera. Like your weakest links in the entire process, right? They're going to take you out. Financial industry is built on risk. Like it is a risky business, period. And any point that you do not understand where the risk is, it will build up. And when things go wrong, that's when the stretchers and body bags get built out. So to some degree, you're playing with fire here, right? And it's not just Bitcoin, wrapping it in these layers in the industry and applying just in a leverage capital market system. Michael mentioned, do you come in and just fill in the hole as soon as you run into a situation where, hey, your company took on risks it didn't understand or wasn't aware of. Now you're in a situation where you need to go out and raise more capital. Well, yeah, you ask Peter Thiel, maybe he'll fill it in. But in a system where you're running at 12 to 1 or 15 to 1 leverage on average, if you don't understand the uranium that you're playing with or poking at, like, you got to be careful. And I don't think we've fully thought through all of the things that could go wrong with putting actual UTXOs into an ETF, like fully liquid 24/7 with elastic create redeem. you mentioned the authorized participants as like a point of failure, Jesse, in terms of kind of like exclusionary, right? Like I get to choose who's in here. But I think it goes beyond that. It's mechanical, right? If you're looking at how the creation redemption mechanism works, right? When I say those words, like that's what makes the ETF special, is that you can be perpetually like open as a pooled fund and trade it on an exchange because you assume these authorized participants in tandem with the market makers who do the actual trading against your retail or institutional clients, right, who are moving in and out and trading shares in your fund. The authorized participant is the one firm who can create or redeem baskets of shares, is the way it works. So the way our firm has an ETF, so I had to learn about all of this. There's people who do this for their living, 20, 30 years of experience, and like they know this inside and out way better than I do. But I understand like the practical elements of this. Like I've actually sat at the keyboard and processed these trades, these create and redeems. What happens with the AP is like they'll get an order from the market makers. They understand supply and demand, and they know like the share count need to go up or down, and then they'll create a new basket. So one basket will be, I think for the filing, it said 40,000 shares.
Yeah.
It starts at its share price of 25. That's $1 million in assets per basket. So let's say an authorized participant, right? We're starting at 0 shares, so you got to create baskets. You'll say we need $1 million worth of UTXOs. There's no other asset that you can get to put it in this basket, right? You have to deliver Bitcoin UTXOs, right? And there's some degree, like if we ever get into a kind of a bar fight, what is the chain? What amounts to UTXO? Well, it's also BlackRock's decision what makes it in there, right? What goes in the basket if it's a fork. You've got to go get those. You got to show them. And, these weights and measures, like here's the price, 40,000 shares worth times 25, $1 million worth of UTXOs. You put those in the basket. Now, you check this against a market where if you look at the dynamics and you look at like the really good kind of analysts we have in this space, this is something that's like unique to Bitcoin that other assets don't have. Like you have an open source community of analysts. Like you've got Dylan McClair out there and Rational Root and people putting together good work and know this industry, I think, better than the entry level analysts and senior analysts that are even on the street. But you look at a market where the available supply for trade probably peaked in Q1 of like 2020 or 2021 in the last cycle. You're declining. What happens in your creation basket when now you need to go create shares and you go into a spot market where available supply to trade is dwindling, right? You got to go get those. And at some point, this market, like if you just follow the logic, like where this looks like it's going, like it looks like 5 to 10 years from now, could, give or take, who knows when that day comes, but it looks like this is a market with a reasonable probability of, the market going no offer. And then what do you do? Like you're in this situation like, hey, did you lend shares out? Like we can't create anymore. We can't go get UTXOs. I mean, I don't think we've really thought about all these things, and there's so many different ways for this to go wrong from a product standpoint. And if you're looking in the rear view mirror, you've just seen, each cycle. It starts with Mt. Gox, and then there's always a body bag.
Yeah,
there's a lot of risk here.
I think you nailed it there. Where like Wall Street is going to burn their hand on the stove, and it's a question of do they do that sooner or later? If they do it soon enough, where the hole that they create from not treating Bitcoin with the appropriate level of respect is fillable. If they can fill that hole, then maybe they'll learn their lesson and not rehypothecate, for example. But you could end up in a scenario where even these giants like BlackRock could. There's a very plausible scenario of BlackRock manages to ingest 1 million Bitcoin into this fund. And 10 years from now, the price of Bitcoin is $1 million per Bitcoin. That's $1 trillion fund. And if in some crash that happens then, and they've been rehypothecating and they're caught swimming without any clothes on, that hole is bigger than the enterprise value, what Michael was getting at earlier, of that entire business, the biggest behemoth on Wall Street. And Bitcoin has the potential to take out every institution on Wall Street that doesn't learn to respect it soon enough.
Yeah, and I think another thing, going back to the custody model, depending on Coinbase, a single custodian, and Matt, you brought up like individual UTXOs, and that's the thing with allocating your custody to Coinbase. Like Coinbase is not going to like be registering those UTXOs. You're not going to be able to go to like the filings of the BlackRock fund and find the individual UTXOs where the shares are held. I find it very hard to believe. I don't think Coinbase does that for Grayscale right now or GBTC. And so it's bad for two reasons. Number one, in the event of a fork, like BlackRock can, number one, choose what they deem to be Bitcoin, the true Bitcoin. And then since you don't have visibility into the individual UTXOs that the fund actually owns, they could say, all right, we're just going to run with this fork as Bitcoin, and we're not going to do anything with the other fork, and they could market sell that and not tell their customers and just rake all that in a way.
But the market will know that. Like,
yes.
You'll stop getting a bid, and once they're like, no, this BlackRock chain, like, we've got them. These are good UTXOs. No, it'll show up in the market price.
Yes.
You know what you just made me think of, Marty? So there's something interesting, without going too far like down the rabbit hole, of Coinbase basically being blessed with this, because it is a blessing, like that they're going to hold this, they're going to get fees. There's a lot happening from that, and we've always had these thoughts or discussions like the government really can't like build custody solutions in the same way they can't actually build whatever currency that is going to be digital, and so there'd be like this public-private partnership, and that's what Coinbase feels like in this world, in a similar Circle. And if you could take that further, it's like BlackRock basically owns Circle in Coinbase now. The problem with that is Coinbase, outside of the fund and it amassing 1 million BTC, Coinbase holds what's the number right now of Bitcoin outside of just in general, like between Zappo, GBTC, and Coinbase? Is it like 2.2 million or something?
Yeah, it's above 2 million.
Yeah. So there's a big problem here.
Yeah.
Alan Farrington included that in his excellent piece about the BlackRock product. He enumerates 8 reasons to be worried about this, and one of them is that BlackRock is so interconnected with the U.S. government that using Coinbase as their custody provider effectively is going to bring Coinbase into the government's control in terms of what they're doing if they weren't already. One of 8 facets to be worried about with regard to BlackRock's product. But on top of the 3 that I enumerated, which weren't actually weren't fully called out in his excellent piece called "Trust Me, Bro." It was an excellent name for an article.
I mean, it's a very interesting 5 to 10 business days when you think about Coinbase sued, whatever Binance, let's not even count that, and then BlackRock ETF blessing Coinbase with it. Like, that doesn't, they're all talking to the same people. The SEC is involved in all of this. The government, it doesn't. It's a very interesting dynamic to now think that BlackRock is working with Coinbase that holds 2.2 million BTC.
Yeah. So do you think upstarts like OnRamp can compete with Wall Street? You think this is a move to sort of box out the startup culture in Bitcoin and let the adults in the room come in? Or are they going to be forced to let us compete?
We're an ant to BlackRock. We're nothing. But from the perspective of a client, you can still choose. Whether you want to have a bike that has this good wheel, this good normal wheel, the grantor trust model, it's a good fit for Bitcoin. And then a square wheel, which is the custody and governance that BlackRock is bringing in. You can choose that. That can be your option. If you're if you don't want to take on self-custody and you want to get direct exposure to Bitcoin while leaving yourself open to eventually taking self-custody without a taxable event, your options are that BlackRock vehicle, one good wheel, one square wheel, or a Bitcoin native investment vehicle like OnRamp, where we've got the good wheel, same thing, but you also have Bitcoin native custody through multi-sig, through multi-party vaults. And that is genuinely a better investment vehicle for preserving you as the client, your rights, and minimizing your risks in that process, because BlackRock is introducing a lot of risks in how they're going to govern this fund. And it doesn't need to be that way, and it shouldn't be that way. And Bitcoiners like us at OnRamp want to bring people into Bitcoin the right way, and empower them to take self-custody when they want, and help them preserve their rights and access to this asset, and not try to dupe anybody into ESG coin. Sorry, this is what you get. Because you got exposure to Bitcoin through BlackRock. Now you're holding BlackRock ESG Bitcoin. It doesn't need to be that way. And it's ultimately up to the individual and the institution to decide what they value. Do you want to go with the big name of BlackRock? And frankly, most institutions will do that, because BlackRock's clients will probably get exposure to Bitcoin through BlackRock rather than upstart OnRamp. But every individual and every institution can make that choice for themselves.
I think Jesse's a little more bearish on OnRamp than I am. I tend, where I've been having a lot of fun is, again, this is like pattern recognition of what we just did. We've seen this, whether it's an Unchained or River. When you think about all of this stuff from first principles, it's very Darwinistic in the sense of like whether you choose the right money or the wrong money. As we alluded to Parker's greatest asymmetry, it's not only to the upside, it's the downside. So if you make the wrong decision, you can't insulate yourself from it. In the same way from the product. So, the idea is like we need the keys to be distributed, Bitcoin, for it to work. That is going to have to happen. And let's say we game out and Bitcoin's successful, then your decision on where you secure the Bitcoin is going to be the difference between you holding Bitcoin long-term and not. And we just seen this play out with the past 5 years, whether it's the lending example with BlockFi and Unchained, or, custody and thinking about building your own infrastructure like River or whatever's happening at Prime Trust. Like this is where I'm bullish is like on the education, because that's what this game's going to be for the next 10 years. We're dealing with alien technology, a new asset, and it's up to us to be able to disseminate and explain that. And, credit to Jesse, Parker, individuals that are able to pull from their traditional finance backgrounds, along with deep understanding of Bitcoin and monetary theory and all the things that go along with it, and articulating that to individuals. And you couple that with a product that's native and that it's inherently native. When you look at it, it's like, do you want a single institution holding it? There's no difference at the end of the day, whether it's BlackRock, Coinbase, FTX, BlockFi, or any institution that's single, or do you want to use the native properties that reduce that counterparty risk? And from a game theoretical perspective, especially if you do it from a jurisdictional perspective, you're not adherent to a single institution or somebody rugging you from that key. Over time, the best product's going to win. It's a free market. And so I, again, having lived this the past few years in previous roles in the space, I see that it's just education that it all comes down to, and then the market takes care of the rest.
Well, that's why we're here, gentlemen, to educate. That's why the last trade exists. And I completely agree with you, Michael. I think that's I don't want to say, maybe Wall Street may have an innovator's dilemma on their hand, where they're too massive, and due to the regulatory environment, they're not able to move as quickly with these unique custody models that exist with multi-institution, multi-sig. Who knows, maybe the regulators will get smart and they'll be able to move more nimbly, but I'm not going to hold my breath for that. And I think that's the beauty of the time we live in right now, the inflection point we live in. There's a land grab going on. Wall Street's going for their grab right now. We would argue on the show that they're approaching it the wrong way, and because they're doing that, we view it as a massive opportunity to do it the right way and show people how to do it the right way and educate people on what the right way is, which is why we're here. Is there anything with the BlackRock filing we want to tie the knot on here? Because I think we should.
One thing I do want to add is we've been doing forget about the fund, or we've been talking to folks, whether on the union side or people that are managing this money. Everybody, these funds that are allocating capital are made of real people. Maybe this ties in the transition to what Matt's working on, and also just his understanding of the mismatch with Social Security, pensions, endowments. That when it comes to the conversation, this is people's money that they're managing, and that they need to think through from a fiduciary. And so as the education happens, that's part of it, is that there's a real people, that they have returns that they're responsible for. And if they don't have to take that counterparty risk, given all the things we just talked about, definitionally they shouldn't, if they care. And so there's a lot here that we're going to be able to do to help a lot of these funds. And then we all know the sooner you're in, the better for the return. So that's really where, as I've been going about the past couple of weeks, it's there's a real duty to help educate these large pools of capital, because somebody on the other end of it is depending on it for their retirement, among Social Security and other things that are associated.
I was just going to close on this one out. I think I don't think there's ever been kind of a situation like this. Maybe there is a case study we can find in history where the playing field on this new paradigm tilts towards the individual, not the scale player, not the large pooled fund. This is hard to do, to map Bitcoin onto the legacy system, the legacy infrastructure. You're going to keep seeing it. There are going to be problems. You rip up the floorboards, we didn't think about that. But if you're an individual, it's super easy to onboard, figure this out. It does take homework. You do have to put the time in, but there's never been more, I would say, just alpha on the table for you. If you do buy in, you'd make that choice to onboard onto Bitcoin. Learn how to do seed words. Learn how to use a sign device like a cold card. Go to one of these on-site events, do a workshop, and take personal responsibility. So I'd say that's the hugely bullish thing, is you as an individual have a table set in front of you where personal responsibility has never been more rewarded, I'd say, in this framework, as opposed to so many other facets in life right now where you can take as much personal responsibility as you want. I can diet, exercise, get enough sleep at night, try to stay healthy. My health insurance premiums are going to go up just like everybody else's, 10 to 15% a year, right? I can't do anything about that. It's just a complete change in paradigm, one system versus the other. So I think that's the extremely bullish thing here, is if you do choose to opt out of your existing option, your existing financial investment choices. We'll talk about this, what people are invested in and saving in for retirement. If you choose to come play in this game over here, game's not the right word there. This new system, this emergent system, personal responsibility carries, it's free alpha. It's the complete opposite of what you're used to.
Yeah, absolutely. And I'd go so far as to say that the people who do that, who take on that, the scary elements of the new, and learn about Bitcoin, do their homework, and take on personal responsibility here, I think that could be the deciding factor between whether middle-class individuals get to retire ever or not. And I see that as where all of this is moving towards. And I think we can dig into, Matt, your work on this about asset classes and individual net worths.
Marty, did you and Logan want to throw up the slides we went over? Did you want to rehash any of those, or just open-end discussion?
I think we'll start with open-end discussion. Just how bad is the retirement situation, private retirement accounts?
Yeah. Well, Jesse, I've heard you talk about this too on other podcasts you've been on, maybe the Citadel Dispatch episode with Matt Odell. You talked about the same things. Where does the middle class, where have they been trained to accumulate and preserve purchasing power? for retirement. And it's two things. It's their homes, it's a primary residence, and that's the big one. We can talk about the housing market in a bit. And then it's retirement accounts, right? So you've seen this whole infrastructure built out, since ERISA. It's a government acronym, but an act passed by Congress in I think the 70s to put an oversight layer over retirement plans. And then after that, like the 80s, the IRS, the tax code was, or the revenue code was implemented to make these like tax favored treatment accounts where you could either get a benefit in a kind of a traditional standpoint, like a regular 401k versus or IRA versus like the Roth. And it's all amounts to, do you either pay the tax today in a Roth and then save, over your working years into retirement, and then presumably you won't have to pay tax when you turn 65 or whenever you hit that retirement minimum distribution age. It's a moving goalposts on when that comes home. Or is it you get a tax benefit each paycheck where you can contribute to this account, every biweekly or monthly paycheck, and not take a tax hit on like right away. You get a tax deduction, and then you save, and then you pay the tax at the end. But it's really been a system that's built out in the incentive since the early 80s to get people to save in this vehicle and financial assets, build up a nest egg. And then, ideally, if everything works, you hit 65, or, that number just keeps going up, 70 and a half now, maybe 72 the next time we hit a new Secure Act. Do you have that nest egg built up? And that's presumably what's going to make up the bulk of your, consumption needs in retirement, right? You have no more income other than you can have your financial assets producing income, but you have no labor income. And that's a model that over like a 40-year bull market in financial assets, where kind of you were leaning into growth for most of it, right? The 80s, 90s, boomers finally worked their way fully into the workforce. So you got a lot of earners, a lot of paychecks. If you throw them in the aggregate, your workforce is rising. You got a lot of income coming in, and then every month there's just a bid in the stock market and a bid for bonds. And rates are coming lower, so everything's just going up for 40 years. That model worked, and then what happens, once you're on the other side of that mountain, and all of those fundamental drivers start going into reverse, and that's it's a really concerning problem if you're looking on a forward horizon when you see, the waves of baby boomers. Like we heard about this, like we knew it was coming, 10,000 retirees per day. And it's here, and you're looking at the metrics. I have this pulled up. I won't screen share.
Can if you want to.
Okay. Yeah,
I love that point, though. I love that point of like now there's a lack of bid. There's been a bid every paycheck for 40 years, and now that bid is kind of diminishing, huh?
Yeah. Can you guys see this?
Yeah, Logan's going to pull it up now. He's got it.
Oh, cool. Let me know if you want me to change the dimensions.
And for everybody out there too, like this is all in the context of interest rates. Like in 1981, interest rates were 15%. A mortgage rate was 17%. So the value of homes couldn't be that much. And we've had a pretty more or less straight line decline for 30 years of interest rates going from 15% to zero, and then stayed there for 10 years. And only in the last year have we seen actual interest rates back again. But that decline is fuel for financial assets to get bid up, because the discounted cash flow valuation models that underpin all these asset valuations, they benefit when the discount rate is dropping, because the future cash flows from that asset, whether that's a company or a rental property, you have to discount them less as the interest rates are dropping over time. So that structural force for 30 years, 40 years really helped bid up financial assets to the sky. So sorry, Matt, you can take it back now.
Yeah, no, it's exactly right. And then once you see, it's like, are we through it, right? Are we on that other side of the mountain? you can't call it while you're in real time. That's just not how, I mean, anybody does it. You can't call it top, call it bottom. You don't know for sure until, 3 years, 5 years, 10 years have passed maybe. But if you're looking at this data and what's happened since, we got that COVID deceleration, right? This credit bubble wanted to deflate upon itself. And then we had to take the monetary policy and fiscal policy actions that took place, right? You look at what's happened in the main asset classes that make up a retirement account, right? It's just stocks and bonds. That's all you can buy in there. And you look at kind of the mother of all fiscal and monetary stimulus, and that only put these markets, or at least the bond market, into kind of like a preservation mode for, I want to say, like 4 months. Like they pulled out the bazookas late March. Bond market topped in early August, so right, they pulled 4 months basically of kind of like a rally there, holding up bond prices. And then it's just been leakage ever since. The bond markets have been selling off. And I know everybody's kind of calling like we're going to hit recession. Bond markets or yields will come in. Maybe that's in front of us somewhere with 6 months, 12 months, 18 months, what have you. This is the most kind of like called for recession in history, I think. But you still see bonds selling off. Like for our existing funds accounts, like what we're trying to do is solve this looming problem hitting fixed income allocations. And I trade these things every day, and you just keep seeing yields come up, like bids are backing off on, it's not just, the treasury curve, it's front end corporate issuers, right? You might see names that seem rock solid, like at the beginning of this year, United Healthcare. I mean, I could just throw out names. It's like these yields wouldn't budge, it seemed like, and then all of a sudden they do. So it's like the levees just keep breaking, and no one knows how this plays out over this cycle. But it just, at this point, from my perspective, having the hands on the keyboard, like just watching these things all day, it's not slowing down, right? So anyway, the thing I wanted to share on these asset classes, what I did is I took the total return indices for the Bloomberg Ag, S&P 500 total returns, to include dividends, and then Bitcoin. And then you take that ratio, total return, and then you divide it by the CPI index, right? Not the hey, it's 9% year over year. No, it's the actual index, like they chart it, and it just goes up and to the right. And that's kind of your proxy for what's your purchasing power of your, let's say, dollar asset savings in that investment class. So we can choose like any starting point you want, like just roll it back forward before, we even knew COVID was a thing, December 31st, 2019. You're going to get a similar result. But I chose this when the bond market started to sell off in August of 2020. It hasn't kind of bounced since. And your bond purchasing power is down, it says 24.48%. So you've lost almost a quarter of your purchasing power in that allocation to investment grade bonds. When I say investment grade, that's just the category of bonds that kind of the street analysts, the consensus is these are, they're investable. They shouldn't be a significant credit risk, right? So that stack, it's lost you 25% as a whole. What that's made up of, it's made up of U.S. government and agency debt. It's made up of investment grade corporates and then investment grade securitized. So think about like mortgage-backed security holdings, just pooled and securitized into a bond fund. That's what goes in there. Down 25%.
Since August 2020?
Since August 2020, right? So since that stimulus, that it could work through at least the financial markets, and then things just took course from there.
Meanwhile, Bitcoin's up 200% in that same time period.
Dollar price, we'll go. So S&P 500, I'll get to Bitcoin third. S&P 500, it's up 6.64% total. So it says 2.37% annually. So once you haircut for purchasing power preservation, you've grown your purchasing power saving in the S&P 500 since August 2020, 2.37%. And Bitcoin, even after, a massive drawdown, like where did it get to from November 2021 to November 2022, like the peak, that was peak and trough. There's a like 85% drawdown, right? So like something pretty significant.
78,
like after
I believe.
Yeah, 78.
Okay. Even after that, you've got Bitcoin up 98.6% real purchasing power preservation, like in that time frame, 28%, 28.36% annualized. So it's like everybody looks at things as what happened this week or this month or, in the last year. But it's, numbers don't lie. Even though it is yeah, go ahead.
Sorry, I was going to say maybe to take a step back on there's the chart on the allocations that I think you had previously went over with Marty. I think helps contextualize like taking a step back, because I feel like you mentioned 2020, but '08 was really where everything started, and the allocations leading up to that on the retirement and homes from individuals and how most got pushed there, and then basically everything's gone downhill from there. Do you have that chart to show, or we can pull it up? Because I think that sets the stage for like the precarious situation from individuals, right, and what their basically like their personal balance sheet is, and then where it falls into institutions and their investment in these different asset classes and how they're all basically not producing any return.
So the slides that Marty and I covered were in institutional. It was like American household balance sheets where they save institutional allocations. That'd be a different set. I don't know if you want me to put these up, Marty and Logan. I can put them on your docket if you want to play these guys.
Yeah, it's
okay. This one?
Yeah, I think it's the main one. Yeah, there we go.
This guy. Yeah, this gets to what we were talking about, Jesse and I earlier. Like that
this
big
is the
gray
story.
in the middle. It's those are the most broadly owned assets and the only ones that have gained value for your kind of your middle class. It's primary residence and your retirement accounts. We were saying those other three buckets. If we're working from left to right, there's a class that's really limited ownership and gained value. Think of these as just like you own financial assets, whether it's like you own share or you're an LP in a hedge fund, you own you have bond holdings, like you own QSIPs directly, you have other pooled investment funds, or you have other residential real estate, so your second home, third home, etc. Those did extremely well. There's a slug then next up, kind of on the left. It's like an orange circle. These are declining ownership and not gaining any value for the typical or the median American who holds them. So number one on here, CDs, cash value life insurance, saving bonds, directly held stocks. That one's actually surprising. I'll walk through that a little bit. Retail traders are like, it's known they're terrible traders, right? We kind of have this idea the thing to do is you buy low, sell high. This is shocking, actually, and the mother of all bull markets for an equity market, any country in history. Your average retail investor doesn't do well. And this comes into Bitcoin too, right? We have this I guess you call it just like a fatal flaw as humans. When we're trying to invest or speculate, right, on an asset, what we do is we go and rush to buy to it when we hear the news. Then we sell it once it's down, right? And when we hear the news or we hear like, hey, Bitcoin price, like this week, for example, it's rallied from 24K to 30K, see it in the news, and you rush to your brokerage or whatever, Coinbase or whatever, most Americans are and how they acquire Bitcoin. They'll go buy then, right? You're buying on a distribution typically. And it's a really hard and rare mindset to do otherwise. Like not many people actually buy low in an accumulation phase and then sell high, or buy low and hold, right? Which works well in Bitcoin too. But in stocks, this data point here, it's on the fourth line. It's just this tiny little arrow here. They get barely any gains, and it doesn't even really create wealth for most Americans when they're buying just equities in their brokerage accounts. So that's kind of shocking. And then other in that group is other financial assets and other non-financial. They're just catch-alls in this. Like they'll pull in for financial assets, like any other credit claims or there's oil and gas rights in some of these, and then other non-financial assets will be things like a commodity if you hold precious metals, or something else, anything physical, like any investment. You would say that's not a financial security or claim, if you will. So I think when I look at that bucket and I see things like CDs, cash value life insurances, savings bonds, like what I see in this, or how I interpret this, these are kind of reflective of a market, or like a product market or product space, financial assets that maybe used to work for people, but they're no longer working, right, at building and accumulating wealth through time, right? So Marty and I talked when I was on TFTC a few weeks ago about what our grandmothers would give us for Christmas, and my grandmother gave me savings bonds, and Marty's gave him CDs. It's like, we're not doing that anymore. Like this is a legacy system that's no longer working. And I think in the cash value life insurance, you see this too in the equities, right? Go look up LNC, Lincoln, but you look at the insurers, like it's not a good picture, right? If you think about these things in the terms of businesses and markets and where the customers are.
What I love about that and that chart in particular is how it kind of connects to what we as a society and a culture propagate as investment advice to the next generation. Us millennials, we've received the wisdom that all you got to do is go out there, get a job, max out your 401k, get a mortgage. You're going to do great, because that's what worked for our parents. That was the winning model. That's what that slide shows. Is that's all you had to do, just max out your 401k and pay down your mortgage. And those are the two assets that were the real winners in that whole landscape over the last 40 years. What's funny about your anecdote about grandparents is that for that generation, CDs made more sense. Those might have been the winners for them. And so that's what they are propagating as like, oh, this is a good thing to own because it'll provide security and stability in a world where you can't trust the stock market or equities or home values to go up. So I can't help but look forward with regard to that. Like, we've received this wisdom, max out your 401k, get a mortgage. But as we've talked about, like, this is a 40-year bull market where the conditions that allowed for that to happen are over. Like, they can't continue. The wind has reversed. And now it's headwinds. There were massive tailwinds for the last 40 years. And now those asset classes in particular face headwinds.
Well,
And so then the question becomes, what does win, and what can deliver the kind of performance that housing and retirement accounts did over the last 40 years in the next 40 years?
Well, the question that remains is, like, are the headwinds actually stronger than the tailwinds that got you to this place? Because with the retirement accounts, particularly, you have like the demographic thing. Matt mentioned it earlier, the 10,000 retirees a day. And so that's like forced selling. You have all the money printing going on. So Matt indexed those charts that we showed earlier to CPI. Like, you're fighting inflation as well as a fall in the value of the assets at the same time. And then like those two alone, was the last 30 years of boomers investing in their 401ks, investing in their housing. Maybe the housing market is like the last bastion of savings for the retirement accounts. But when it comes to like financial assets outside of real estate, like, was it all a mirage? They had this false sense of security for decades leading up to retirement.
Let's talk about housing, and just let's go common sense here. The housing stock, the American housing stock, it's old, it's aging. Like, the median house, like, you can go look this up. It's like 1980. Half of the homes are built before 1980. I think that exactly, it might be like 1978. So it's an aging housing stock. Odds are, if you're a new entry buyer, you're in your 25 to 40 time type of age group right now, you're looking to buy your first home, get your down payment, whatever. You're probably buying something from the existing housing stock. If you're really lucky, you're just knocking it out of the park. Maybe you get a new build, right? Existing housing stock. You're buying an old home, like it's 20, 30, 40 years old, maybe older. And then right now, with the rates sell off, bonds are not holding their value, yields going up. You've got the 30-year mortgage rate at 7% now, like it's just hit 7% again. Back to the same level. They haven't been at a 7 handle since December 2000, so right at the end of the dot-com bubble. So now you're paying a 7 handle. Again, you're signing up to finance this house, 30 years at 7%. You're going to sign up for all that, that payment stream for, most of the time. It's probably going to be a house that, it's been through a few mortgages already. You're getting the same house. It's just depreciated another 23 years now, right? What's happened since price, or what's happened in that time frame on price? The median existing home sale price in December 2000 was about 150K. Now it's 396K. So about 150K to 400K. Like you've gone up 175%. The new entrant now in this system, what it's asking you to do, this financial system, what it's asking you to do to buy your new house, and on credit with 30 years of payment stream, is asking you to buy the same house at a 2.75x value. It's older now. It's going to take more input, more costs, more replacement. You're going to have to replace the AC. You're going to have to replace, you name it. There's costs involved. It's a depreciating asset. Now you're going to pay 2.75% on the same 30 years at 7%. It's truly mind-boggling, right? That asking this system that says, hey, what's the American dream? It's homeownership. Like, you too, young couple, young man, young woman, you can have a garage for yourself. It's just absurd. It truly is. Like, we couldn't even hand it down, like that same set of opportunities for like one generation. It's I don't know, just common sense.
It's also almost like some got rugged. I was part of this, like in 2021. You're hearing, it's the common thing that Jesse was referring to, is the in-laws or whoever is telling you the wisdom. Buy a home, diversify, hold it, and you bought at 2% or whatever interest rate, and the market falls out. In most cities, it has, unless you're in in Austin and Asheville, these markets. So now you're upside down, and the recession hits, and so now you're out of a job and you're upside down, and your inflation's running, so now your cost of living's going up. It's a complete mess.
Every cycle you put through this, like, it gets harder. But even still, like Jesse was talking about, like, does it work, right? When does it stop working? If you had bought your house in 2018, right, you've seen real estate prices go up now. You finance, like, you got a chance, like your purchase mortgage, and then you got your rate cut, and you're at a 2.5% or a 3% now for 30 years. And you're like, wow, now these new buyers coming in are pushing my house up, and they're signing up for this, indentured servitude for 30 years. It's like, well, really, really hard on them. But from your perspective, as someone who was in the trade even like 3-5 years ago, it looks like you're in the money. So it just takes time to get past that tipping point. But when you frame it like we just did, and you see that this new like your new home, everybody's going to be happy once they get a pair of keys and approved for a mortgage and close on their house. When you look at it in reality, it's like, no, you just signed up for 30 years at 7% on the same house that was financed at that 25 years ago, and now you just did it for 2.75x the price. It's like, all right, at what point does this stop working? No one knows. Like, when you're working through a credit bubble, and I count the mortgages as a big part of that, right? The home prices, like, banks lend against them as collateral. It's riding that same trend up. So at some point, like, your prior entrance to the market, well, maybe it felt like in 2022 it wasn't going so well for your buyers in 2020 and 2021, but oh wait, this next batch will push the tab on them. And I think that just pushes to the lack of fairness in the dynamics of the system, right? When we're asking the youth to sign up for that, it boggles my mind that we are operating in a way. It's like basically we're choosing to eat our young, and that's what that existing kind of framework, that the credit-based financial system is willing to do. And then if you go over here and play in Bitcoin, it's those same set of rules and circumstances. Like that's not part of the table stakes of adopting onto that system.
Yeah, like when you're talking about like a long-term store of value, Bitcoin, your UTXOs don't depreciate. You don't have any maintenance fees on them if you're custodying it yourself. It's extremely liquid. You don't have to worry about the interest rate environment and whether or not you'll be able to offload your Bitcoin onto somebody else. There's always going to be a buyer on the other side of the market there. You can take it wherever you want. It's not location dependent. Like houses, obviously, it has to stay where it is. There's few houses outside of RVs and mobile homes that you can take with you. But yeah, when it comes to housing too, it does feel like we're at like the Wile E. Coyote moment, where I think that's been the big theme the last couple of weeks. That the home builder stocks have been ripping because people are realizing that nobody wants to sell their house and then go get a 7% mortgage if they have these 2.5-3% mortgages locked in. So people are literally being forced to go build new homes that they can then move into.
Yeah, I keep thinking about the book When Money Dies, and that's about all these little vignettes and stories from Weimar Germany, of like what that investment landscape and environment and climate looked like and how that evolved, and just stories from it. And hard assets did so well, and speculators on hard assets did well on the surface, because it looked like they were doing well. But really what was happening is the money was losing its value. And I'm starting to wonder if we're kind of seeing that with housing in our current era, where there's a flight to hard assets. And for our culture, that means a house. And it's the only thing you can trust, because they're printing more and more of the currency. And when money dies in our current era, is translating into like, okay, you're going to be fine if you have a house. You just get your house, you pay whatever arm and a leg. And ironically, or paradoxically, that can work out as an investment, because as the money is dying and they're printing more and more of it, the inflation causes the value of that home to shoot upwards. So like, if the COVID stimulus was the reason for the real estate boom that happened in the 2 years following, which I think it was, house prices went up 30% in 2 years during a pandemic. And I think it was because the money was dying a little bit more right then. And what's wild about that is that people who were sitting on a mortgage saw the equity of their home, or the market equity that they could realize, increase, because they were holding this debt contract that they had to pay out in nominal dollars from the past. So the loser there in that situation is the bank, which is kind of a surprising and rare feeling, if that is what's happening here. If real estate continues to boom as the money dies, the dollar dies, the dollar has to be inflated away, because we have to inflate away the national debt. Real estate could be one of those things that on paper works out well, because it's sort of retaining its purchasing power. Even if it is losing in real terms, it can still do well in nominal terms. And people will think that they're geniuses for investing in real estate. So I wonder if like a starter home here in LA went from before the pandemic, a starter home was like $700,000 in LA. It's an expensive housing market. Now it's $1 million. And it's not going down from, or maybe it will, but it hasn't gone down from the pandemic rally. And so now a starter home is $1 million, 7% mortgage. Good luck paying your $70,000 of interest, on annualized, but, and we could see if we have another crisis that necessitates a massive stimulus, which I think is what we're heading towards. When we have another COVID style stimulus, they have to print a bunch more. The housing market could see the same sort of 30-40% bump happen again. And then a starter home is suddenly 1.3, 1.4 million. And whoever got in at this level looks like they're a winner on nominal terms, but it's the money dying ultimately. I wonder if that's
like there's a corridor here. I'm imagining, right? There's the melt up, right? The prices continue to go up, or there's the deflationary bust. When we realize in this game of musical chairs, right? There's not enough economic activity out there for everybody to service their debt, and then what? The banks had to foreclose on everybody. You just end up with an angry populace, one way or the other. It's like you're leaving out the new entrants. It gets harder and harder for them to achieve the same things, with each progressive generation, or it just ends in pain for everybody. It's an unstable kind of path you're trying to
very unstable
to navigate.
So Jesse, that's really there's something really there, like what you said about, because there's something like insidious about the common mantra or narrative is you can't eat your bonds, you can't eat your stocks, but you need a house, you can live in it. And so it's the thought is you buy your home, and that's where you put the money. And this I remember so Fannie Mae, when the government subsidized for homes, happened after the Great Depression. And it was after this big crash. And there's something to like this fact of, well, you don't know if the money's safe in these other places, but you can live in the home. We can put our dollars. It's a way for capital to flow. And it's not until you have the opportunity cost we've talked about, I think, on the first episode, because I was part of this before finding Bitcoin. It's like you save capital and you're like, well, what do you do with it? You don't really know about stocks, and you remember something happened in 2008 and that it's not necessarily the safest place. And so you're thinking about where does it go? And like, well, I guess you're supposed to buy a home and it appreciates and you see in markets. But then that completely changes when you think about the opportunity cost. So you have the down payment that we've talked about, and then what's the current price of BTC and the liquidity profile and all the things that go along with that assessment that just doesn't exist when you're looking at it from the traditional lens of what Matt was showing on, traditional like balance sheet of an individual. And I think that's exactly right. It's like when the money dies, when you don't have anywhere else to put it, you're putting it in the place that at least if everything else died, you have a place to like live in. You have a place to, shelter your family. It's a very like sad and scary thing, because whenever this thing does fall out, to Marty's point about the Wile E. Coyote, like it's not going to end up good for anybody. And they're just going to be holding these bags of mortgages that, we talk about the price. Just randomly was talking last night about the in-laws' house that was $18,000 when they first bought it. This is like, a small town or whatever, but it's still the point that every year, you're 20, 30 years depreciating. So the asset's not getting better and the price is basically 10 to 20x that. There's something very wrong with that system.
Yeah. So when the Wile E. Coyote reality sets in and gravity takes over, I guess like the historical parallel that pops out is Luke Gromen has been talking about Israel in the 80s and what they had to do to get out from under their debt situation, which was massive inflation to inflate away the debt. And the bondholders are the losers. So that's who gets robbed in order to get out from under a crushing debt burden. It's the bondholders. And you can think like that's the banks, but it's ultimately the people who have 60-40 portfolios, and the 40% gets just just evaporated. And in a way, that's sort of happening. I mean, what Matt was walking through, 25% purchasing power destruction in 3 years, that's that process in action. And of course, it can go a lot further. And that's your debt jubilee, which is a funny thing where, you could have homeowners who have this nominal debt contract suddenly find that it's much easier to pay that off. But their 401k that includes a large bond allocation is also robbed from. So, it depends on how you're allocated then, right? Where if you're overweight your house, then you come out ahead if you torch your 40% bond portfolio, bond allocation.
Well,
so yeah, it ultimately, this could really hurt pensions is kind of the long and short of it. And retirees in particular who shift to greater percentages
based off
bond allocations.
Well, based off the charts that Matt just showed, like it is. And like back to the point, when money dies point that you make, like people feel like they're wealthy on paper because asset values are going. Like, is that like that was the point I was trying to make earlier? Like, has the last 30 years of these boomers building up their retires just been the mirage that they think it's there? So like if you mentioned a 60-40 stock bond split, but like towards, like Matt and I went over it, like the target date funds, like they shift you to 80-20 bond stocks by the end. And if you have a 25% fall in purchasing power of those bonds, that's 20% of your overall portfolio as you're heading into retirement right now over the last 3 years, which is insane.
I think, what it amounts to is like all that exists are the goods and services in the economy. Everything else is just claims on those, right? If you look at what we stacked this system, what it's done, like just by, trying to manage the business cycle, like with the, fiscal policy, monetary policy, and, stimulus to try to smooth that out over, basically the entire time since World War II, 70 years. What you've ended up doing is creating more claims on the goods and services that exist in the economy than exist, right? Because we think like, you create more credit, that'll increase the amount of goods and services in the economy. That'll increase growth, right? And that's the framework. It's like you got the money, the money multiplier from just policy and fiscal stimulus. It'll work, whatever. And it clearly doesn't, right? You look at the charts, it's like the amount of credit creation versus the amount of economic growth, and it doesn't keep up. So at some point, you estimate right now, what's the amount of dollar credit claims outstanding? IIF says it's $300 trillion. You don't really know how much credit is out there. And then you look at GDP, just on the order of like $25 trillion. So even if you don't spend any, or, you put in no, maintenance or everything that goes into maintaining that GDP, the next 12 years is already spoken for. Like the claims already exist. So now if we just keep creating more credit, you got more claims. You got more claims built up on the same amount of goods and services, essentially. Like you're not going to get real growth. And we've known that. Like the book has been written that real growth is not coming out of this system. Like we've known that since at least 2008. If you're a policymaker, it should be written in stone, not in pencil anymore. Like it's known, this system, the credit creation model, it's not creating incremental growth.
Yeah.
So not to keep going back to that. Yeah, go ahead.
Yeah, Jeff Booth in The Price of Tomorrow lays out how it's incremental $4 of debt to drive $1 of GDP growth at this point, which is not a winning bargain.
And then if you keep doing that, right, like essentially you get to a point where it just keeps putting you further and further behind. And I think, so policymakers have realized this now, and there is a hesitance. So you're saying like there's going to be another, deflationary crisis, something like 2008, something like 2020. But at this point, we know like the lessons learned after 2020 have shown you like that is not, an infinite trick. You just can't keep doing that. And expect this to get better. Like, for example, like China stimulus, right? They see the writing on the wall, like the global economy is slowing, their exports are slowing, et cetera. And they're only just starting to apply, the most, like just a couple pinches of salt worth of stimulus in. Like, we'll cut the policy rates by 10 bits or something. They're not coming in with bazookas, like they did in Q1 of 2020, because they know what they thought was a steroid. It's actually, more likely a poison, and you just keep putting yourself more and more behind. And I think at this point, everybody has realized that. And now we're in the mode where, say, like as policymakers, like if you're setting monetary policy, it's like, oh no, we have to err to the downside risks and try to over tighten as be stronger. Don't be so easy. Don't be doves, be hawks. And you see that around the world. Like, you saw 2 central banks today. Like, Norway was one of them, like, increasing rates. So they're swinging the pendulum back the other direction almost. And then that goes back up to the point of when money dies. Larry Lepard, highlights. Sorry for that. Apologies. Highlights the Myrmikan chart, right? The gold price in the Weimar inflation. And if you just look at the averages, it's just like, oh, that's a smooth. Just buy gold and hold it. And it's like, no, you realize, like, it's a system that wants to toggle from, like, inflationary melt up to deflationary bust, and it's just gonna swing in between, and it's a really messy, chaotic process. And I think we're, like, collectively only just starting to awaken up to that fact. The bells went off in 2020, and that's the world we're living in now.
Yeah, I get the sense that we are on track for a deflationary crunch that will then, Luke Roman has brought up this phrase that isn't from him, but I heard it from him, so I'll credit him, that deflation is the midwife of hyperinflation. And the deflationary crunch causes the crisis that necessitates the stimulus that causes the inflation. And that's what the trajectory of Weimar was this increasing volatility in inflation. So not the average inflation rate went up over time, but it was actually just an increasing whipsaw between high inflation and negative inflation, deflation, that ultimately led to money dying there.
Exciting times, gentlemen.
All I could think about, I was thinking about, chasing from a personal or institution perspective, BlackRock ETF and trying to get a Bitcoin allocation over time to, be able to sustain the living that people want, or the returns. But then I ended up, and I was thinking halfway through this, that's very bullish. And then the other side, I was like, oh, but then the Bitcoin sits at Coinbase. So there's a real, it is a call for us to build people out there, to build products that are able for others to adopt, that have more principles that are, what we know about. But I just couldn't help but go through that progression of, okay, well, there's going to be a gradual and suddenly, and they're going to recognize Bitcoin as an asset, and BlackRock's going to be an ability for that to happen. It's going to be helpful. But then over time, that basically puts them in this position to hold a lot, if not the majority of BTC via Coinbase.
You can get it right here. You can have the right conclusion and have the right allocation and still pick the wrong investment vehicle that ends up becoming a goose egg because of some unknown risk, some hidden risk in the governance or custody model of that vehicle. And I'm afraid that that's going to happen. It's happened in crypto with BlockFi, or people who put in their hard-earned money into Celsius because they thought that they could live off of the interest, and that's going to be a winning model, and I can retire early. Nope, that's a goose egg. Same with BlockFi. People who had lots of assets on FTX, and Wall Street's going to do that too. In some different ways, that outcome is going to happen for Wall Street firms who are going to go through the learning curve of how to correctly engage with this asset class in general. And it's a real shame, because there's going to be a lot of people whose pensions, they're going to have the bond portion of their pension go up in smoke, and they're going to be thrilled that they got some Bitcoin, as part of their allocation, and that part's going to do well. And some of those people are still going to get a goose egg because they had it with the wrong custodian or the wrong governance model. And that's why Bitcoin education is so important here.
Yeah, and I think it's important. Like this is part of this podcast, but also anchoring it to real world practicality. What Jesse just referenced, we saw happen with IRA accounts with Gemini. So there's a firm, I don't remember the name, but if you Google Gemini IRA, it'll come up, that used Gemini, and there's actually two, and both had Gemini involved. One was the firm used Gemini as the custodian, and these are boomers, so they have an allocation and they got phished. And so there was, I think, $50 to $75 million. And if you think about the one amount, like the one allocation of funds is your retirement, that should just be offline cold storage, you don't need it. They lost it. They got the trade completely right, and they were rugged because of the custodian and like just the intermediary. And then the other side of it, which Gemini also had involved, but in a different relation, is they had a partnership with Eaglebrook, which is kind of a quasi, I'll get it a little wrong, but a tech platform for FAs and RIAs that are supposed to be super prudent, risk averse, but they love the yield. And so between the FAs looking at that and also, Gemini having right next to their the ability to get that 2, 3, whatever Genesis was promising, that these FAs and clients were like, oh, I see 3%, I can get this on there. And now there's a close to $1 billion hole that's sitting between that for people that went in there. So you still found the trade, but because the vehicle wasn't correct, because the asset's different than just the dollars, and whatever happened with Robinhood, you click a button, you revert it. It doesn't work that way in this asset. And so that's a big part of all this, is like, we're not just saying these things because we're thinking about them or as possibly could. Like we see this happen time and time again. And so it's important to like talk about it and then share so that it doesn't happen to the individuals we're involved with.
Yeah, I'd say you need to know what you're like. Do your research. Anytime you put Bitcoin or you were talking about dollars and yielding products and putting them in a wrapper, right? History, the young history of the Bitcoin experiment has made one thing clear, and that's ultimately those things that you thought were Bitcoin will turn into like once it's in the court of law, it's a credit. You just bought a credit product and you took credit risk with no upside. Like there's no positive upside in this for you. And it goes back to what I was talking about. Like there's alpha on the table here for the person, the individual or partnerships who want to learn and exercise personal responsibility. Like this is a tool, but it's on you to learn how to, understand it and kind of map like the ownership structure that works in this new paradigm. But yeah, don't buy what you thought was an equity. It's the opposite of a convertible bond, right? You think you have a bond with some upside, like it turned into the good thing if things went well in your favor. Like when you buy products like that, you're doing the opposite. You're buying something you thought was like an equity-like or risk-like product, like with a return profile. And it turned out you bought a credit, and it turned into the credit when things ultimately went bad for you. You
bought Suzu's yacht.
Yeah, exactly. I mean, and when you put it like in this context too, that would be one of the saddest things that could ever happen. Is you're riding the wave, Bitcoin goes to 6 figures, 7 figures maybe, and you're like, yes, I made it, and you get to the end and you get rugged because
who loves it? Who loves this? The lawyers. The lawyers love it. Like this is just long drawn out court battles, etc. And it just that's who your allocation is ultimately going to go to. Like a big chunk of it will go to is the legal system.
Mt. Gox is going on 10 years now of that whole case. So
that just reminded me of it may not even be the rugging may be self-inflicted in the sense of not only the wrong decision but the wrong philosophy. Because we talk about ESG, whatever the narrative is going to be, people may fall into that trap of like, oh, of course the proof of work is bad, and like BlackRock has it under, or whoever the large entity is. Like, oh, that's not my coin. Little do they know, wrong decision there, and they hold 0 coins.
Don't let Fink think for you, okay? That's some original thoughts. ESG is an ephemeral trend that's dying. You do not want to get on the ESG Bitcoin train. you're gonna get
But
run.
isn't Bitcoin bad? Isn't Bitcoin bad for the environment, Marty?
No, Bitcoin. Honestly, I earnestly believe this. Bitcoin is the catalyst for the environmentalist future that we want to see. Like, we're going to be extremely efficient from an energy perspective. I mean, I can beat the dead horse on how Bitcoin mining makes us extremely energy efficient, off-grid and on-grid. Miners are economically incentivized to find the lowest cost energy. That is, energy is wasted or stranded, underutilized. So just by going and taking that electricity that's being wasted and utilizing it to produce Bitcoin, efficiency gain. Stranded energy, same thing. You're tapping into something that is out in the wild and cannot be brought to market. You bring the market to that thing and you monetize it there. Beautiful thing. That's the first order effect of the energy. Second order effect is the monetary policy, which actually brings opportunity cost back to markets so that you have to weigh capital allocation decisions. You're not just able to print money and throw it willy-nilly at stuff that probably shouldn't be invested in or have capital allocated it to. So, yeah, Bitcoin is incredibly good for the environment, directly and indirectly, on a first order and second order effect.
Yeah, the most ESG thing out there, actually, if ESG was actually about environmental, social governance, this is that, because it's the greatest tailwind for renewable energy, and it brings like equity and property rights to everyone in the world who's unbanked, and prevents those people from being robbed via inflation. And so it empowers the individual in a way that nothing on earth currently does. And yet it is smeared as this thing that is bad for the world or bad for the environment, when the opposite is true.
But
maybe Marty and Larry Fink working together.
No, even with that being said, I was just about to say, I know what you're going to say. Jesse, don't even fall into their framework. ESG is a dog whistle for control. Like, they don't care about the environment. They don't care about social justice. They don't care about governance.
That's what I mean.
They don't care about any of this.
If it was actually about that, then Bitcoin would be in the good graces of BlackRock. But it's not about E, S, or G. It's about what we deem to be a good corporate citizen based on what's good for BlackRock and the U.S. government.
Yeah.
Well, to bring this back in along, tie the energy in with the BlackRock ETF, I think as this plays out over time, and we're talking like years, you see, all right, an ETF will bring capital into Bitcoin. We'll go through layers, but it has to get there. And then you see kind of the mechanisms of how kind of the financialization kind of engine is now going to have to plug in and play in this new space, right? You see a market that has to go buy UTXOs into a no offer market. Now energy is kind of back, instead of taking a back seat for the last 15 years, and policy. I mean, in every table that matters. Now energy is back up, at the front of the wedding reception, at those tables close to the decision making. So I think it gets energy back involved as a stakeholder, and then I think it's just part of this broader process of financialization suppressing input costs throughout the economy. Right? You see this everywhere. Like it's. The WTF happened in 1971 charts, right? You see labor costs like just flatlining. You can see it in commodities charts. You go look at the copper chart, like long term. You see it break, right about between the dot-com bubble in 2008. You see these cost inputs just going up. You see iron ore, et cetera. And it's like, I think it's just a part of everything breaking the kind of the engine of financialization that was, keeping things stable, prices low for 40 years. And now you slowly see everything like just one rivet at a time. People look at the oil markets. You saw pressure build up in 2008. You saw the technology of fracking, kind of alleviate some of that pressure, right, and provided deflation in oil. But the thing about the credit system is it has to fill any deflationary hole, any technological advancement, anything new. It has to gobble it up and just create more credit. It will just abhor all of that vacuum. So it'll just continue to suck out air in space. So I think if there's one positive coming out of this week, I think this is, as kind of Bitcoin and then the legacy financial system, the credit money, the credit dollar standard, go head to head. You start to see these two binary stars orbiting, and there can only be one winner coming out of this room over the long run. It will be a messy process in between, but I think those linkages are there. Over time, the economics win. At the end of the day, it's undefeated, and we're going to find out. This is the exciting thing. So, what is unmaintainable will not be maintained over the long run.
Which then means, Marty, what's that phrase that you like to say?
We're going to throw a grenade at the fiat system? I'm kidding. Which phrase?
We're going to win.
Oh, we are going to win. Yeah. Because we got
if
the
economics wins, we got a binary star problem here. One doesn't have the economics to support it. The other does.
That's, I mean, win. And I think as much as we've been denigrating BlackRock and their particular fund structure and their custody model, I do think it is a signal. Like you compound that announcement with Jerome Powell, the House Financial Services Committee meeting, saying, I think crypto has staying power, with like Fidelity, Schwab, Citadel. I think the incumbent financial system does understand the gravity of the problem to a certain extent, and they, at the very least, view Bitcoin as something like, all right, if these guys are right, we should at least have some exposure to this and lean in at least a little bit as a hedge, which...
Reality is you have to take what the market gives you. There's a lot of opining on, is it good or bad for Bitcoin? It's like, it's happening. And so you have to build products and services that the market wants that fit to the model of it. Because it's going to happen. So.
Well, yeah, exactly. And that's something that MBK says all the time. And he actually tweeted earlier this week. We can have our critiques on particular ways Bitcoin products are structured by certain companies. But that's also the beauty of Bitcoin. Bitcoin's an open, permissionless system. If people want to interact with the protocol, there's nobody to stop them from doing so. If they can download the software, if they can get access to private public key pairs and put UTXOs in them, they can begin building structured products around that if you want. To Michael's point, you can sit here and cry about it and whine about it and say, this isn't the way to do it. Or you can go out and outcompete and build better products that the market will recognize over time. Which we're coming up on 2 hours. And before we wrap up here, speaking of products and things that people are building in the space, I think is a good time to sort of wrap up on a good note, on a white pill note, on how Bitcoin fitting into traditional credit portfolios can sort of help ease the pain of the transition as we go with what you guys are building at Build, Matt.
Awesome. Yeah, so I think I've been pretty public about this, but we were working on a project with Unchained for a long time. Marty, you've talked a lot about on TFTC and RHR over time about their lending model and their best practices built around their multi-sig vaults. And then a lot like the on-ramp custody model, where you bring in key management with multiple stakeholders. On-chain lending works the same way. So Unchained is really, if you think about it, we were talking about earlier about all these blow-ups, BlockFi's, Celsius, etc. They don't need to be named. They shouldn't be remembered. Just put them in the, just tombstones of the body count of mistakes that have been made and lessons hard learned as people try to figure out how to build upon the resilience and soundness of Bitcoin infrastructure. But Unchained's lending model is something that really stuck out to me as I was considering in 2020 and 2021, as we were watching that bond market sell-off get underway, and I realized this isn't going to work for our clients. And this is a mission that I've kind of been going after for, I'd say, 10 years, the last 10 years of my life, just knowing that something was coming with these bond allocations and that something had to be done to save our parents, friends, families, et cetera, the workers in our communities. You guys talked about, municipal pensions, firefighters, police officers, et cetera. Our communities need saving here. So this is where, we need to build solutions to solve that. And that means not just, getting people to understand Bitcoin. If they do choose to adopt, teaching them, the ways to do it soundly, key management, et cetera, that Marty and Matt do such a great job week in and week out. But it means like finding other ways as well. And that's where, over the last, it's coming up on almost 2 years since, I first met Parker and we were trying to figure out how we could get Bitcoin incorporated to save the bond market problem. And that has materialized into launching Build as my firm. I manage, this is my day job, Build Asset Management. We launched a private placement pooled fund, which exclusively invests in Unchained's Bitcoin-backed loans. So if you look at the profile of how we could see a credit allocation having a fighting chance to keep its head above water and preserve purchasing power in this environment, what are you looking for? Well, one, minimize duration. Whereas, Jesse talked about the last 40 years, duration was your friend as rates just kind of cycled down. Lower lows, lower highs for 40 years in the biggest credit bull market, on the way up on that mountain. Well, what did things look like on the other side? This is where you had to really be clever and design solutions that, hopefully protect your clients and allow them to preserve some purchasing power in this dollar credit system. So high nominal yield, low duration, and then also secured with a lot of value behind it. So 40% LTV loans are equivalently 2.5x over collateralized. And then most importantly too is perfecting the security interest as a lender in that collateral. And that's what I think as Partners Unchained does a better job at, or has done a better job at building, very conservatively over the, I think it's almost 8 years now that they've been in existence. So shout out to Joe and the team there. We think they're onto something. I think they stood out, in our due diligence as really peerless in this emergent space. So that's my day job. That's what we're doing. And then on top of that, there's some other projects I'm working on. So my hometown is Jefferson City, Missouri. I've been, just shooting this idea out with Marty it's been a while, but we're making it happen. We're going to hold an event in Jefferson City, Missouri on October 26th and 27th. I'm going to call it the Bitcoin Expedition. Just find it a good title. It's where the Lewis and Clark expedition, close to it, launched off. And Jesse, you've written about that too. You got to go out and explore the West, right? And that's what this new opportunity, this new space is. Really exploring and educating how Bitcoin and this opportunity in front of us can really tap, growth. It's the next level, the next field to explore, if you will. So we'll be doing that. There'll be an investor day we're planning, and then an education day. We were going to try to line it up with a Mizzou football game, so SEC football, hold a tailgate with other Bitcoin companies coming in and sponsor, and just meet and greet, Q&A, have a great time with your fans. Unfortunately, that's not going to work. We couldn't get a date that lined up on the schedule for just Bitcoiners and the audience as well. There's a couple marquee events going on around that time frame too, but hopefully we put on a good one this year. And we'll get that football game on the calendar for next year. But this is an event where if you're a Bitcoiner in Kansas City, St. Louis, Des Moines, Springfield, Omaha, you can even go as far as like Memphis, Nashville, and expand. But it's a close drive for 4 to 5 hours, and I think we're going to make a lot of headway. Not just kind of Marty, last week on RHR, you and Matt were talking about, it's the same people over and over. It's not going to be that. I think we'll get a lot of your favorite friends, and people you've already met, relationships built in the Bitcoin community. But there's going to be a lot of new blood here. We're making to make some headway. Open hearts and minds to learning about this new opportunity and what it can do for the region. So we're excited to announce that. The website is going to be bitcoin-expedition.com. We spun it up today, so we've got tickets available for Friday. Investor Day will be on a invite basis. So just because everybody has to be an accredited investor or financial advisor, institutional audience, or work in the industry, we do need to make sure that everybody coming in is just an appropriate audience by the nature. But Friday is going to be GA Day. It's going to be a great time. We've got great venues booked. So bringing a kind of a Bitcoin-only, Bitcoin-focused event to hopefully somewhere that, there's a lot of passionate Bitcoiners out there. Marty, you've probably learned this over and over again, people just reaching out to you on TFTCC episodes. But after our episode, I had people from our hometown, career placement at my at where I went to graduate school at Washington, St. Louis, et cetera. Like they're out there. They just need that gathering point, and I think this will be an event to help make that happen. So that's something else we're building and looking to put on.
I'm very much looking forward to it. That's something that has astonished me, and Michael and I talk about every once in a while. The freaks are everywhere. It's crazy when you get people reaching out and across the spectrum from your plumber to some of the wealthiest asset managers in the world. It's a special thing because we're working on something special here.
That's a good time to give a shout out. So there's another freak that says hi and thanks for Marty for helping him on his Bitcoin journey, and also hi to the team. He put together the audio that is going to be the new audio for the last trade. He wanted it. He goes by Johnny Hoddle on Twitter, and he does musical services in Canada. So he said he's available if anybody wants to reach out for weddings and bar mitzvahs.
Well, Johnny, you did an incredible job. I love the intro. Should we play it now? Do you have it up, Logan? It should be in the Slack. You should be able to. Is it not possible?
If you can, I'll give a little note on if anybody's seen the entourage when he goes on and he gets the free speakers and he puts the hat on. That's what I told him, that it'd feel very much like the putting on the hat to get the speakers, but we would give him a shout during the pod.
The people have already heard it. It's at the top of this episode.
Yeah, Matt hasn't heard it yet.
What if they fast forwarded? Yeah, I want Matt. I think Matt's gonna enjoy it. If you can. Well,
I'll get it. You don't have to make everybody else. Let's do it twice.
Did you guys hear that?
No, they wouldn't have heard that.
No, you wouldn't have heard. All right. Well, you guys heard it in the beginning of the episode. We're dragging on here. Matt, thank you for joining us this week. Anybody listening that wants to learn more about the intricacies of the retirement fund landscape, go follow Matt on Twitter. He's always tweeting, and go check out Build. What's the website for Build?
Build's website is getbuilding.com. If you'd like to learn more about this project I talked about with Unchained, you can go to buildbitcoin.com. And then my Twitter handle is @buildcio.
Go check it out. Episode 5 of The Last Trade in the books. Go forth and enjoy your weekend, freaks.
Thanks, guys.
Thanks, Matt. Thanks, Johnny Hoddle.
Shout out, Johnny.
Johnny Hoddle won.